Smart Silver Stacker here. Hope you're doing well. Thanks for joining me for another live stream on this lovely Sunday afternoon. So, there are a lot of red flags which have been presenting themselves recently, warning of an impending market crash. And I want to go over some of the most recent warnings that we've been receiving in regard to these overvalued markets and talk about what that could mean for the price of gold and silver moving forward. And also, I want to go over a little bit of history today regarding currency devaluation, one specific instance in particular, which I think may be of interest to all of you watching. Now, if you'd like to get some gold and silver yourself, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold and silver at spot by visiting sdbullion.com/new. That is where I buy my gold and silver. There is a link down in the description. Now, this first warning I want to cover is from a major banking institution. It's from Bank of America, who has warned, according to this headline from Bloomberg, of a 5% world and some economic contraction, which may result from the environment of rising interest rates that we continue to find ourselves in. I got a few folks in the chat saying hello. Hello to all of you. Please do smash that like button if you're tuning in. Help get this information out into the algorithm. Now, this report from Bank of America, we have analysts there warning that investors should brace for the return of a 5% world, the kind that prevailed before the global financial crisis and the era of near zero US interest rates. We've also got BlackRock Inc. and Pacific Investment Management Company. They have warned that inflation could remain stubbornly above the inflation target set by the Fed. So, surprise, surprise. I mean, I think that most of us have been aware of that for some time, that inflation is very real. It's here to stay, and it is much worse than we are being told. But even the official numbers remain elevated, and some very large financial firms confirming that that is how they view the inflation trend will continue. And that means that interest rates are going to need to remain higher. And that is going to put a lot of pressure on these markets, especially when you consider how leveraged up our economy has become. You know, we've got a huge amount of national debt. There's this report from the New York Fed came out recently. It was the household debt and credit report from Q2 2023. Credit card debt in the US now exceeding $1 trillion. Mortgage balances still extremely high. All forms of debt, student debt is extremely high, $1.57 trillion. And so this economy that we have is fragile, and it will be sensitive to this prolonged period of rate hikes. If the Fed has to keep rates high for a prolonged period of time, and they very likely will due to the fact that inflation is proving to be persistent, then there is going to be a lot of economic pain that comes out of this. One of the things that was a bright spot was the recent GDP report, which showed that the economy was growing according to the GDP, but a lot of that was driven by consumer spending, and that is all being financed by debt. Rising interest rates is going to limit that. We're going to see a contraction eventually. I mean, maybe this economy can withstand 5% plus interest rates for a quarter or two, but what about a year? What about 2 years? What if rates go higher? What if it goes to 6 or 7%? Eventually, something is going to break. There is no doubt about that. And when it does, that's really the big question. What happens when something breaks? What happens when we get a major market sell-off? Does the price of gold collapse along with other assets like stocks? Does silver sell off? Trombone Music MS, this is a great question. Do you really think silver will protect us if there's an economic crisis? Well, there's a few ways to answer that question. Yeah, I think that if there's a major economic crisis, having physical metal will likely be better than holding fiat paper or having, assets in a bank account. I mean, there's very possible that, say we get a banking crisis. I mean, your assets in the bank, they may be frozen. You may not be able to spend them. Sure, paper money that you have outside of the banking system, that's fine, but that is likely to be devalued. And I think any response to an economic crisis on the part of the Fed or the current administration or any future administration for that matter, the way things are going, will likely be to intervene, and the intervention will probably be worse than the crisis itself. But at this point, yeah, I would rather have physical metal. Now, if we have a real true economic collapse, you're probably going to need more than silver to keep you safe. Will silver keep you safe if someone comes and tries to take it away from you? Well, you could throw your silver coins at them, I guess. Maybe a nice Scottsdale Kit Kat bar could serve as a bludgeon in a pinch, but no, it's not going to keep you safe in that regard. So, you need to be doing your other preps too. You need to be focusing on security, food, perhaps having some uh, collaboration with individuals to come up with security. But we talk about the economic side of things here, and yeah, I think that silver is probably one of the most undervalued assets out there in a world of massively overvalued assets. We'll talk about that in just a moment. Someone asks, why do I have copper out here? Well, don't worry. When I get to the economic history portion of today's live stream, we'll be talking about silver. That's why you see it out here. I'm sorry, about copper, this nice 2 kilo copper bar. And no, just to answer your question, no, I don't think that 2 kilo copper bars or any kind of large copper bullion is better than silver. Most of this stuff you have to pay a huge premium over the spot price, but you'll see why I have this out if you stick around. All right. Yeah, Mike Schaefer says metal and ammo. Yeah, exactly. You might need a variety of metals to protect yourself in the event of a full-blown economic collapse. I mean, look at places where you've seen inflationary collapses in the past. Look at Venezuela, skyrocketing crime rates there. So that's something you've got to be prepared for as well. And silver's not going to do you much to protect you from that. But what silver will protect you from is currency devaluation, hyperinflation. And right now, I mean, it's so cheap. It's just so cheap that I think it is a steal. Of course, not financial advice, I'm just giving you my thoughts. This is another story. Here's a warning. Michael Berry, the famous trader of The Big Short, has initiated a $1.6 billion short position in the market. So he is shorting the S&P and the NASDAQ with a combination of $1.6 billion worth of put options. Now, he certainly called the last financial crisis, well, maybe not the last one. We've had a few since then, I guess, but the big one in 2008, made a bundle off that, shorted the subprime market with the credit default swaps and all that, made a huge fortune. And, he's called for market sell-off since that time. I don't believe that he's gotten those calls quite right, but still a very successful trader. And when he initiates a huge position where he's really putting his money where his mouth is, like a $1.6 billion short position, I think we all should be paying attention. This is a measure of stock market valuations, the Shiller PE ratio. And this is interesting. So the way that this is calculated, it's a little bit different than your typical PE ratios on the stock market. It's kind of it's an average, and the way that they calculate it, it's based on average inflation-adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio. And so this is a good way to tell how overvalued the stock market is at any time. This is of the S&P. And you can see that right now, we're not as high as we got in the 2001 tech bubble, but we're actually right around the valuation level that we were at on Black Tuesday, when the huge stock market collapse that kind of set off the Great Depression happened at the end of the 1920s there. You can see we're right at that same level. So certainly at the very high end of the chart, stocks are incredibly overvalued in, today's market. Now, a lot of that, we've got some new bubbles being inflated. We got this AI bubble in tech stocks. It seems to be another bubble, if you ask me. But across the board, many of these paper assets still very overvalued. And a lot of that has to do with the policy of keeping interest rates extremely low. That one that, Bank of America was talking about, the post-financial crisis environment of extremely low interest rates, easy money, still in effect here. And we have just reinflated the bubble every time it pops. In 2020, we saw a big decline in assets. What did the Fed do? They came in and they bought up trillions of dollars worth of treasuries. They slashed rates. They pumped this market back up, and it's still up there at this extremely overvalued level. And you got guys like Michael Berry who are now beginning to short it. So he's beginning to think that we are approaching some kind of a collapse. And I will say, if Michael Berry nails it twice in 2 decades, then that'll be very impressive indeed. So, not saying that there's going to be a market crash tomorrow, but things are very overvalued. And certainly, I mean, when you look at the macro picture, the geopolitical situation with de-dollarization and de-globalization, and the BRICS emerging markets kind of trying to take on the West in the economic arena of the global economy, then it just seems like when you have massively overvalued paper assets and rising interest rates and rising inflation against that backdrop, you very well could be in store for a market crash. Now, I want to talk about what could happen to the price of gold and silver if that happens briefly, and then we'll get on to some more warning signs that are out there. So, if we get a major stock sell off, it's very possible that the price of gold and silver will fall along with everything else. But I don't think that physical paper and I'm sorry, I don't think physical gold and silver will fall in the same way that the paper version will. Paper assets like the futures contracts, ETFs, those will very likely get sold off as the race for liquidity ensues, and the dollar index will probably strengthen significantly if that occurs. But then I do think we will see some Fed intervention. I think that the assets will get blown right back up. How long will that take? I'm not sure. But I think that we will see intervention on the part of the administration and the Fed. And the thing about the gold and silver, and also, metals like copper and platinum, really just any physical hard assets that you can hold, I think they may keep their value. I mean, I think very well this could be the big one where you see a divergence of the physical metal and the paper markets. A lot of people talk about how gold and silver are manipulated and the prices will only rise when the COMEX allows them to and when JP Morgan allows them to. I mean, yeah, maybe the prices are suppressed. The prices definitely are suppressed to some extent. We just don't know how much. I mean, that's why JP Morgan traders have been convicted of spoofing the gold and silver market and why they had to pay close to $1 billion in fines for metals manipulation. But how much, who knows? But here's the thing about metal manipulation. I don't think that the metals are going to rise when the manipulators allow them to. I think they'll rise when the manipulators lose control. And we saw what happened back in March when the bank started to fail. You couldn't get your hands on this stuff. It became the proverbial unobtainium. I mean, if you wanted to get your hands on it right away, you'd probably have to pay an exorbitant premium. Otherwise, you had to wait weeks to get it shipped out to you. And, that's why you want to get your hands on metals when they're available, when they're cheap, like they are right now. I mean, we've seen a bit of a pullback in the price of gold and silver. We got gold hovering around $1,900. I think it touched under $1,900. And premiums are pretty reasonable right now. So now is exactly the time when you want to be stacking, when everybody's kind of skeptical. Everybody's thinking, oh, maybe there will be some deflationary forces. I mean, that's how I think about it anyway. Like, I think now is a good time to stack. When the banks start imploding or you get a market crash and everybody starts, running around trying to get into some kind of safe haven assets, whether that be the US dollar or physical metals, that's not really the time to be accumulating. I'm not saying it's the time to sell necessarily, but that usually means if you wait until that happens to accumulate, you're going to be paying a much higher premium than if you buy now when markets are relatively calm. It's kind of like the calm before the storm. You can get gold and silver for a relatively low premium, especially considering the environment of the past several years, where we've had these high premiums. They're pretty reasonable right now. So I do think that the price of physical metal, maybe it'll drop a little bit, but I think eventually it'll take off because of the intervention. And you may not see even really sales on this in the event of a market crash. Maybe you will. If you do, take advantage of it. I had someone in the chat there just ask a question about the BRICS conference. Will the BRICS conference affect the price of the metals? That's the big question, right? That's the big question. We got the BRICS conference this week, and we'll see what kind of effect it has. I mean, maybe it'll be a big nothing burger. I put a poll out on the channel, actually. You can go to the YouTube community page and participate in that poll if you want. Seems like a good portion of people, less than half, but a lot of people think nothing will happen. But then most of you think that there will be some kind of disruption, whether that be a disruption to the petrodollar, BRICS expanding, maybe Saudi Arabia joining, maybe they're going to start taking yuan for oil, who knows. Okay, I got Elaine Roy in the chat there saying premiums are a scam. Now, sorry, Elaine, I got to disagree with you there that premiums are a scam. Premiums just represent the real price of the physical metal. Because you got to remember the spot price, it's not the price of an ounce of silver. It's the price of a futures contract on a paper market. And there's, hundreds or potentially thousands of paper contracts traded for every underlying ounce of metal that exists on that exchange. If you want to take delivery of metal that you buy at spot in the form of a futures contract, you got to take it in 5,000 ounce increments. In the silver market, if you're talking about the COMEX, they're going to give you big 1,000 ounce bars. So the fact that, a 1 ounce round carries a bit of a premium over that price, it just makes sense because, it costs a lot more to make 1,000 of these than it does to make a 1,000 ounce COMEX bar. Or you could say the same thing. It costs a lot more to make 5,000 of these and distribute them to retail investors than it does for someone to take, 5,000 ounces worth of COMEX silver in the form of those giant bars. I hope that makes sense. I know this is one of the areas where there really seem to be a tremendous amount of misconceptions in the stacking community, that premiums are just greedy, dealers jacking up the prices. No, that's not true. There is supply and demand in the physical market, and that's why premiums fluctuate, right? Because as much as you want to say gold and silver are manipulated, that's just the spot price that gets manipulated because any manipulation, it's not occurring with physical metal. No one, JP Morgan isn't taking a million ounces of silver and dumping it into the market to crash the price. I mean, if they want to crash the price, they just short a bunch of silver with fiat currency, non-existent, silver paper contracts that aren't backed by real physical metal. That's what they use to manipulate things. And, when you see the premium go up on physical metal, that just means that the price of physical metal is higher than the price of paper metal. That's all it is. That's all it is because the gold and silver markets are very weird. It's a scenario where a paper derivative of gold and silver, that's the futures contracts, actually determine what they call the spot price. And it's a very, tail wagging the dog kind of a situation. So anyway, that's my take on premiums. Let me know if you disagree in the chat. This is an area where there's a lot of misconceptions, though, and I see them a lot in the comments on these videos. All right. CNN reporting fears grow of a Chinese economic slowdown. Here's another red flag of an impending potential market crash. Let's talk about the news coming out of China. They have got their inflation rate declining. They have got the price of housing there just declined for the first time this year. Lots and lots of concern about what's going on in China. China was supposed to be the big driver of the global economic recovery. They were going to be demanding all this oil, producing all this stuff as their COVID lockdowns ended. Now it's looking like they are showing a significant amount of economic weakness. And who knows, maybe the next black swan, the next major collapse will be coming out of China. That seems very possible. They are sort of the growth engine of the global economy. Their growth is slowing down right now. One of the things that will really impact the gold and silver market here, and also the U.S. Treasury markets, because this stuff is all kind of related, is that if the Chinese economy begins to collapse or they feel like they need to intervene there, one of the things they're probably going to do to try to bolster the yuan and bolster their own currency is they're going to be selling off more U.S. Treasuries. You got to remember, China is the second largest holder, foreign holder of U.S. Treasuries. This is the most recent report from the U.S. Treasury on major holders of U.S. Treasury debt abroad, and you can see that China, they're just below Japan there. They've sold off another more than $10 billion worth of U.S. Treasuries from May to June. 846.7 billion down to 835.4 billion. So the Chinese are continuing to sell off their treasuries, and it's very possible that if they experience economic contraction and they need to defend their currency, the yuan, which has been devaluing against the dollar, they may accelerate this treasury sell-off. Now that's going to come at a very bad time for the US economy because the US Treasury is increasing its amount of debt that is being auctioned. They are trying to finance these massive deficits that the folks in Washington are running. I mean, we're approaching a $2 trillion deficit this year, which is pretty amazing when you think about it. I mean, I think it took like 206 years to run up the first $1 trillion in the US national debt. And now this year alone, we're racking up $2 trillion. So, I mean, it just goes to show you how this thing is becoming like an exponential debt crisis. The interest rate on that debt is soaring. I'm not going to pull that chart up from the Federal Reserve again, but we've looked at it several times where the interest on the US national debt is just soaring upward at this exponential rate. And that is going to get much worse if international owners of U.S. Treasury debt begin auctioning off their debt. That will drive interest rates up even higher because, as bonds decline in value, as the bond market gets hit, as bonds are sold off, yields go up. And so, or you could say that as yields go up, existing bonds drop in value. This is a huge problem in the U.S. banking sector we've talked about. The U.S. banks are sitting on all of these low yielding U.S. debts, and as interest rates continue to skyrocket, those holdings are declining in value. And if investors get scared, if they try to, or not investors, but depositors, just folks with bank accounts at these regional banks, if they try pulling out their money, that's going to force them to sell those assets at a loss. It's exactly how this whole thing kicked off in March when SVB had to do that. And that could trigger a banking collapse. And the longer US rates remain elevated, the more risk that we will see that occur. The risk continues to grow. The risk continues to grow. Scott Sim says the Saudis are accelerating their treasury holdings now. Yeah, I mean, the Saudis are big holders of U.S. treasuries, but here's the problem. What if the Saudis abandon the petrodollar? And we can look at the data here. I've got the report pulled up. Saudi Arabia, they've been more or less flat. I mean, if you look, though, the trend for them definitely has been down. Right now, they're holding $108.1 billion, or they were in June, according to the most recent report. And if you go back, I mean, I know it's kind of hard on this like sell sheet, but you can see they were holding 121 billion like within the past year. So the Saudis even dropping their treasury debt. And, if they abandon the petrodollar system, that's the system whereby they sell all of their oil for dollars, and then they recycle those petrodollar profits into U.S. treasuries. If they abandon that, that's going to put even more upward pressure on interest rates. And this is why Bank of America is warning of this higher rate environment, because this is going to cause the cracks to show in this massively over-leveraged economy very shortly. Again, I think the Fed thought they'd crank up interest rates, inflation would come right back down, no problem, and then they'd begin cutting rates again. But it's, persistent. The inflation is persistent, and that's not shocking. I mean, when you have the federal government running a $2 trillion deficit nearly to keep the economy afloat, that's highly inflationary, and slashing the federal funds rate, or rather raising the federal funds rate, 25 basis points at a time isn't going to be enough to counteract that. And there's also a tremendous amount of inflation already baked into the cake. There's all the QE, all the asset purchases that have already been made. And so, this really is a sign that there could be significant pain. And the fact that assets are so overvalued, the Shiller PE being at the same level that we were at in Black Tuesday, that is no accident. That is a sign that there is plenty of room to fall when things start to collapse. And the big deal here is that when it happens, I mean, look at the last intervention. Look at 2020 when we had the Fed come in and they bought up, $4 trillion worth of treasuries to keep interest rates low. The thing about this stimulus is that every time you do some kind of an intervention in the economy like this, you keep kicking the can down the road, the subsequent interventions have to be bigger in order to be effective. And so, I mean, if the Fed wants to stop this next crash that we have coming, it's going to be a massive intervention. And, the story is always when you see these things happen, oh, how could we have seen this coming? How could we have seen a crisis? But there's always a crisis around the corner. I mean, that's just, we're living through history, folks. There's always something that comes up. And you can either be robust or even anti-fragile, if you set yourself up appropriately. But when you get super leveraged like our economy has, you're very fragile. You're the opposite. And that's why there have to be these massive interventions. But the problem is that they just keep making you more and more fragile. More debt gets accrued. Interest rates get slashed to stimulate things. Well, now people borrow more, but they shouldn't be borrowing. That's the problem. In a free market, you would allow businesses to fail. You would allow inefficient things to fail. You would allow bad debts to get written off. But we don't have any of that. And that's why the precious metals are just, incredibly undervalued at today's prices, because the coming collapse, what it will be met with, I think will ultimately send the prices soaring. I mean, I'm just telling you what I think. This isn't guaranteed. I don't have a crystal ball, but this is my forecast. I mean, I look at all the data available, and this is just what I see coming. Maybe a crash, maybe a decline in the metals prices, but then everything's going to get reinflated. And the thing about gold and silver is that right now, I think investors are largely convinced that the Fed will be successful in their inflation fight, but they're going to get a rude awakening. And when it becomes clear that they're not, that is when the gold and silver price will really take off. Because right now, everybody thinks, well, why would I want gold or silver, right? Inflation is coming back down. We got this disinflation narrative. Rates are coming up. High rates means, bad for gold and silver, right? Well, we're going to find out. Now, I think the Fed's going to lose its inflation fight. They've been successful in the past at fighting inflation, like Paul Volcker in 1979, but he had to crank rates up a lot higher than Jerome Powell has, and even then, it took a long time to get inflation under control. And the scenario back then was one where foreign holders were buying up U.S. Treasuries. We had like $1 trillion in debt instead of 32.8 trillion. And this time around, it really is just a little bit different. And it's not the first time we've seen this in history, though. So if we get a collapse, I think there will be further dollar debasement. Just keep in mind that this is the inflation calculator from usinflationcalculator.com. And, they want to talk about disinflation or how rates are coming back down, but I mean, the dollar has already been devalued so much, right? I mean, if you go back 10 years, if you had $100,000 in 2013, in order to have the same purchasing power today, you'd have to have $131,000. And it's accelerating this rate of inflation. If you go back just to 2020, if you had $100,000 3 years ago, now you would need $118,000 to have the equivalent purchasing power. And that's according to the CPI, which understates the real rate of inflation drastically. So, I mean, the dollar is already getting eviscerated. And the fact that gold and silver haven't soared as a result is an indication that they are on an extremely, fire sale pricing at this point. And it's just, I don't know. I view it as a huge opportunity, a way to transfer wealth over to whatever is coming next. Because the dollar, I mean, I do believe the dollar is, its days are numbered as the world reserve currency. I think the dollar will be around in some form for some time, but it's not going to be the way that it's been around for the past 50 years. We're headed towards a change in the global paradigm. And there's a lot of normalcy bias out there. People think, oh, that could never happen. But look, that's the norm. It's normal for things to change. The US dollar wasn't the reserve currency before World War II. It was sort of the British pound. And World War II knocked that out because the British Empire got massively indebted as a result of fighting two world wars. And even then, the Bretton Woods Agreement, that didn't last that long. They came up with that following World War II. That only lasted until 1971. And now we're on this purely fiat dollar or maybe petrodollar system because oil sales and commodity sales around the world are denominated in dollars. That kind of provides some synthetic demand for the dollar, props its value. But that could change too. And when it does, the whole system's going to change. And, hard assets are the place to be when that happens. This gold coin, you could take this back 2,000 years and you could spend it. People might, look at the writing and the symbols on it and think, well, that's weird, but they'd realize it was silver and it would still be money. So they're the kind of asset that can really get you through a paradigm shift. Now, this I thought was an interesting piece of history. We're going to get to the history piece here, which has to do with copper. I don't know how interested all of you are in monetary history, but I find it fascinating, and I think it's something that stackers should study. So I'm going to read you a little bit of this book here, Globalizing Capital by Barry Eichengreen. And this is regarding the gold standard and the silver standard, and one particular episode in history, which I really found fascinating. So this is the prehistory of the gold standard. Silver was the dominant money throughout medieval times and into the modern era. Other metals were too heavy, such as copper, or too light, gold, when cast into coins of a value convenient for transactions. These difficulties did not prevent experimentation. The Swedish government, which was part owner of the largest copper mine in Europe, established a copper standard in 1625. So a copper standard, that's pretty fascinating. Back to the book here. Since the price of copper was 1/100th that of silver, full-bodied copper coins weighed 100 times as much as silver coins of equal value. One large denomination coin weighed 43 pounds. This money could not be stolen because it was too heavy for thieves to carry, but wagons were needed for everyday transactions. The Swedish economist Eli Heckscher describes how the country was led to organize its entire transportation system accordingly. So, a conversion to copper money. Why does that matter to us? How is that relevant at all? Well, we're going to do a little bit more about the history of this in this Wikipedia article, which I think will shed some light on this for us. This is interesting. This is the huge coin I believe they are referring to in that book. It's an $8 DALER piece of plate money currently in the British Museum. So that's a 43-pound chunk of copper. Can you imagine going to the grocery store with that? Um, all right, so I'm going to read this brief article from Wikipedia to you, and then we're going to talk about how this is relevant to US dollar devaluation. So, the Swedish Empire had the greatest and most numerous copper mines in Europe as it entered into its preeminence in the early 17th century as an emerging great power. Though poor fiscal policies and in part the First Treaty of Augsburg, Sweden lost control of its reserves of precious metals, primarily silver, of which most had fled to the burgeoning trade economy of Amsterdam. In 1607, the Swedish King Charles IX attempted to persuade the populace to exchange their silver based currency for a copper based coin of equal face value, though the offer was not generally taken up. Sweden's large army of the time were paid entirely in copper currency, further issued in large numbers by Gustavus II to finance his war against Ferdinand II of Germany. The face value of the copper coins in circulation now greatly exceeded the reserves of the state and production of the national economy, and quickly the value of the currency fell to its commodity value, which in a country where copper was so abundant was small indeed. The savings of the people of Sweden were wiped out. So think about that. That is inflation via debasement of the currency into copper. Now, this is very interesting because we live in historically, this is a bad case of inflation, right? But we've also done the same thing. I mean, we've swapped out our silver currency back in 1964. We swapped it out for copper currency that's clad with nickel to make it look like silver. But keep in mind that in that story from Sweden, the commodity value of the coinage was less than that of the face value, right? That was the problem. But in today, here in the US, we have taken it to a whole other level. This is coinflation.com. You can see there a nickel, which is actually primarily made of copper. It's 75% copper, 25% nickel. A US nickel coin contains 111% of its face value. It's worth 5.5 cents just in terms of the metal weight. So, I mean, we've devalued the dollar here so much that even the copper tokens that we have are worth more than the face value on them, than the dollars they're denominated on. I mean, it's absolutely wild. One thing I do want to address here, and this is just something I've noticed kind of in the stacker community watching YouTube and talking about these coins and everything. This site, coinflation.com, has led to a lot of misconceptions, I think. So it says here 1946 to 2014 nickel. And I think that people believe that that means that in 2014 they stopped making nickels out of copper and nickel. That's not the case. I just think that this website hasn't been updated since 2014. They are still minting nickels out of copper and nickel. You can still get them at the bank. However, there is some legislation that has been proposed to remove the nickel from the coins, the nickel and the copper. And, I don't know what they'll change them into, maybe zinc currency or steel currency or maybe plastic. Or if we get a CBDC and we go cashless, I guess it won't be a problem anymore. But I mean, that just shows you that even copper coins now are worth more than the paper dollars that they represent. So we have taken this to a whole new level, the currency devaluation. And when you see stories like that, and when you look at the inflation calculator and you realize how much the dollar is being devalued, when you see silver sitting at less than half of its 2011 high, it just shows you what an incredible misread of conditions investors are assigning to the precious metals. I mean, the fact, gold has moved up, but gold is still way below its inflation adjusted all time high. In 1980, gold hit 850 bucks, and if you adjust that for inflation, even with the CPI, that puts the all-time high for gold over 3,000 bucks. And if you do the same thing with the silver high from 1980 at $50, you adjust that for inflation, it means that in order to hit new highs, silver would have to hit almost $200 in today's money. And that, again, is just according to the CPI. So the real inflation adjusted all time high for silver, probably well north of $200. And you can get, I think, a silver round, even with premiums, for like $25 today. It's incredible. I mean, this stuff is just so cheap. And so, I'm still stacking. I'm going to keep stacking. If we get a market crash, I welcome a crash that actually brings the price of physical metal down because, you got to buy assets when there's blood in the street. You want to accumulate things when they're cheap. You don't want to go out and buy, now again, not financial advice, but I personally don't want to go out and buy Nvidia stock because the AI revolution. Meantime, their PE ratio is like several hundred. The value of the stock just absolutely incredibly overvalued, and the same goes for most paper assets in today's environment. And that's why folks like Michael Berry is shorting the paper assets. Now I don't know if he's stacking. That would certainly be interesting. I wouldn't be surprised if eventually when the dollar devaluation, the true nature of it and the extent of it becomes sort of mainstream, I wouldn't be surprised if we see folks like Michael Berry or Elon Musk or any of these other prominent figures in finance start talking about the precious metals. And when they do, well, that's when you're going to see the public rush into the metals in a big way, and premiums will soar, spot price will tick up, and it will be too late to accumulate the metals. Then it might even be a good time to sell. If the precious metals go into some kind of a bubble, it might be a good time to lighten up on them, but they're still extremely undervalued, if you ask me, and they might get even more undervalued in a market crash. So I'll be stapping some more up. But I hope you enjoyed today's video. That's pretty much it for I want to cover in today's video. I hope you all enjoyed it. Please do smash that like button. Don't forget to comment and subscribe. Share the video with your friends, and stay safe, everybody. Happy stacking, smart silver stacker.